It's a new trading week on Wall Street. Stocks having a little bit of trouble on this Monday, but longer term, the S&P 500 is up 4 weeks in a row, its longest winning streak since last summer. Well, let's get more on the markets from Chad Morganlander. He's the senior portfolio manager and the co-founder of Washington Crossing Advisors. So I want to start with these momentum stocks because I noticed Tesla is having trouble today because of a deadly accident over the weekend. Peloton got a warning from regulators about one of its treadmills. Crypto had such a nasty tumble over the weekend. The fact that these momentum stocks are breaking down individually on individual news, what does that kind of tell you about the overall market?
So I think that the overall market in general is somewhat toppy. Our expectation is that our long-term forecasted return expectations are somewhat low in relationship to historical trends. So investors have to be somewhat more nimble and also be somewhat more cautious and circumspect about the individual companies that they're willing to invest in today.
So does it mean that some of these momentum stocks have just run up too far, too fast, and that investors need to just take a moment and take a look at them again?
Yeah, I mean, you have named several that are very good companies, but their valuations at some point just start to defy logic. So the concern is not about the here and now, but what the expectations that are valued into the company going out 5, 7, and 10 years are quite lofty. This is all one of the reasons is that you have interest rates that are so dramatically low across the globe, with the Federal Reserve saying that they will not be hawkish anytime soon. So their policy and as well fiscal stimulus together, coupled as a convergence together, has lifted all boats higher, in particular many of these high momentum stocks.
So I wonder this toppiness that you speak of. We noticed that stock prices are up, but also earnings, expectations have gone up as well. So I'm wondering, does that mean that earnings expectations are too high above where stock prices should be? And so that means that stock prices are going to have to come, both earnings expectations and stock prices are going to have to come down?
Yeah, you have earnings expectations for 2021 at roughly about $180 per share for the S&P 500. If you put one of the more generous expectations out there of $220 for the S&P 500 for 2022, you're coming in with a 20 PE multiple, more or less. So that's historically quite rich. So that's the reasoning behind, our somewhat more cautious viewpoint that investors should not be looking at growth stocks and be fully invested in growth stocks, nor should they be fully invested in low quality value stocks, but look at the highest quality companies that make sense, that don't have that speculative fervor behind them. So you could look at healthcare companies, for example, consumer staples, and there are a handful of industrial companies that can continue to play this revival game in regarding COVID and it being hopefully in 2002 behind us. So that's I think the more prudent way of doing it.
So let's stick with your thesis for a second here and bring in the bond market, because the yield on the 10-year note at one point looked like it was racing towards 2% with no stopping. Right. And then all of a sudden it stopped and headed into reverse. How does that play into this idea of a toppiness in the stock market? Especially now if bond yields have gone back down, does that mean these large cap growth tech stocks look more attractive like they did when bond yields were low?
So our viewpoint is that one should look out several years. And our viewpoint is that the U.S. economy can grow at a rate of about 2.4% over the next 5, 7, 10 years on average. I know that there are going to be bumps in the road, which is a lot higher than the Federal Reserve at about 1.8, 1.9%. So what that is telling you, and what we're suggesting, is that you're going to see over a longer period of time a normalization of the yield curve, where inflation is going to start improving, jobs are going to start improving, capital investments going to start improving. So the long end of the curve could go from 1.6 or 1.7% over the next several years to plus 3%. And the Federal Reserve eventually will have to move away from that zero rate policy. So that to us is quite meaningful. And that too could be meaningful to speculative asset classes that are really quite exciting right now, but individual investors should take caution.
All right, great. That's Chad Morganlander. He's the senior portfolio manager and the co-founder of Washington Crossing Advisors. I'm Conway G. Gittens, and this is Reuters.